Welcome everyone to FX Street. It's Tuesday, March 1st, 2011. My name is Adam Rosen. Very happy you could join us today. As always, we have a very fun topic to talk about. What type of trader am I? I made the chart a little bit bigger. Please let me know, a little bit wider, I should say. Please let me know if that needs to be adjusted again. What type of trader am I? I think it's an important topic because at the end of the day, I think the difference between a winning trader and a losing trader, a trader who makes profit or doesn't over time, the margin is very, very thin. You know, a lot of the trading strategies that are employed, that if we were to only improve our entry by a few pips, you know, get in a little bit of a better price, maybe place a little bit of a better stop order so we don't get stopped out prematurely from too many trades, you know, let the winners ride a little bit more, cut the losers off a little bit faster. Excuse me. I think that could make all the difference in the world. I think what happens, and, you know, I'm speaking from my own personal experience to a large degree, I think what happens so many times in our trading experiences is that, you know, we might tend to try a style that appeals to us and seems lucrative, but maybe it doesn't suit our own personality or our lifestyle or our schedule, whatever it may be. So I think it's important to just take a few moments, you know, take a little bit of an introspective look. A look inside all of us and try to figure out, okay, the trading style that I employ, the type of trades that I look for, you know, does that really suit the type of personality that I have and the type of trading style and my lifestyle as well. So we're going to try to cover these points. I know it's not something directly related to charts, but then again, it kind of is. So if you have questions, comments, then chat them in any time. I want to ask myself the question, do I make decisions in the markets based on fundamental logic, fundamental data, or the charts? Now, I think that both can be applied, but each one of us definitely has a focus towards one or the other. It was explained to me a long time ago that why do we have so many different technical indicators? We have the MACD and the RSI and the slow stochastics and the fast stochastics and, you know, hundreds of them. They all basically measure the same thing, price over time. I mean, does a MACD, the moving average, convergence, divergence, does that really bring up something and reveal something that the RSI does not? Not really. They all kind of measure price over time on a technical basis. Why do we have so much? Because just the way our brains are wired, some of us tend to relate better to the MACD, or the MACD seems to make a lot more sense. Some of us tend to look at the trades a little bit earlier before they occur. Some of us like to wait for real confirmation before getting in. The MACD happens to be a slower indicator than the RSI, so it's logical that we'd expect those of us that jump into trades too early, maybe the MACD is better suited. Let me show you the MACD, by the way. Here we have, by the way, there's a Dow Jones Industrial Average futures chart. Here's a MACD, moving average, convergence, divergence. That's the bottom chart, the histograms. The middle chart is the ATR average true range. And we can also throw in the RSI as well. And the point being is as follows. Where's my RSI? Average true range. Relative strength index. Okay. RSI on the bottom tends to measure the market on a scale of 0 to 100. Indications above 70 are considered very strong, below 30 very weak. Typically, the buy signal occurs when we cross below and back above 30, and we sell above and back below 70. The difference is, and this tends to be quite reactive, the difference is the MACD, moving average convergence divergence, this yellow histogram, is a comparison of the 12 and 26 exponential moving averages over 9 periods. But because it's using the moving averages and waiting for those moving averages to get a little bit closer or a little bit further away, it tends to move a little bit slower. I also use the 26 exponential moving average as opposed to RSI only on 14 periods. So getting back to what we were saying, the MACD, moving the yellow indicator, this is histogram, works in a little bit of a different way because what we're looking for, notice how the market made a little bit of a new low when we hit lows of 90, 9,500 going back to July of last year. Now, we would have wanted to go long the Dow Jones Industrial Average at that point because the MACD made a higher low. See, the market makes a low, the MACD makes a significant low. The market makes a new low, the MACD makes a higher low. You can actually draw horizontal lines to sort of demonstrate what this looks like. We have a horizontal line there showing a lower low on the Dow Jones Industrial Average futures, higher low on the MACD. That is divergence. That is disagreement. That, I think, is that type of signal maybe suits a certain type of trader that is comfortable waiting for the signal. That is comfortable and saying, okay, I understand that I might not be able to get in at the bottom, at the exact bottom or top. That's quite all right. I'd feel a lot more comfortable with the signal waiting for that additional confirmation. A trader who uses that might not be very comfortable with the RSI because the RSI requires us to be a lot more reactive and say, okay, I'm going to get in exactly now because now is when the indicator tells me to do so, and I'm going to get out as soon as it tells me to do so as well. Maybe we can't sit by the charts. Now, of course, this is a daily chart, so these signals don't occur every day. But the fact of the matter is these MACD signals, I think they take a lot longer to develop, and it requires a lot more patience on our side. You know, as a friend of mine used to say, you really have to sit on your hands sometimes and resist the urge to press buttons, to press buy and sell buttons. All too often we open up, especially new accounts. We have a new strategy. We're just absolutely thrilled, to get involved and to start buying and selling. And the next thing you know, we find ourselves over trading. It really does behoove us to wait for the signal. The MACD is really going to make you wait. The RSI, for those of us that, do we just have to press the buy and sell signals, it's going to give us a little bit more gratification on that side. Now, getting back to the original point, do we prefer, in terms of our own personalities, do we prefer to anticipate new trends or rely on past data? All too often, our fundamental analysts, let's talk about the U.S. economy. Let's go to the dollar Swiss. Now, the U.S. economy, it has not been good lately. Well, lately it's gotten a little bit better. But over the long term, it has not been good. And the anticipation that the Federal Reserve will not raise rates has led the dollar to new all-time lows. There's a dollar Swissy. And there's really not a lot of anticipation the Federal Reserve is going to raise rates anytime soon. In fact, the only strong sector in the U.S. economy at the moment appears to be manufacturing. Housing is not strong. It's impossible to try to get credit right now to invest in a business or a home or anything of that nature. There's not a lot of reason to anticipate the Federal Reserve is going to raise rates. Well, if I don't expect the Federal Reserve to raise rates, not a lot of reason to buy the dollar. In fact, I think you could pretty much continue to still sell short the dollar. That type of trader that is going to use that information and say, you know what, I'm going to look to continue to sell the dollar and sell the dollar as much as possible, we say the trend is your friend. Now, I think the trend is your friend, that silly little, saying, I think that should try to be applied as much as possible, regardless of what kind of trader we are. But I think within all of us, as far as trading is concerned, all of us tend to want to gravitate towards one of two directions. Either we want to rely on the past data. We can say to ourselves, look, the dollar has gone down, down, down. It will continue to go down until the writing is on the wall, until we break above this former support that is now our new resistance at 93.40, until we break above our upper resistance at 9,700. And I don't care if I'm not going to get in the bottom, but I am not going to get in as long as this long-term trend is to the downside. And I'm only going to get in if we really break out to new highs and then a new trend to the upside begins. Trend is your friend. Now, there's the other type of trading personality, I would say, where we prefer to anticipate new trends. We tend to prefer to look for those signs that say, things are turning. We have hit the bottom. Let me try to pick the bottom. I don't care if I get stopped out one or two or three times, but when I'm right and when I finally am able to pick the bottom in the dollar, look out. I might be able to get long the dollar down to 9,300 and ride it all the way back up to 116. Now, I hope that I am the former. I hope that I have the discipline to stick with the trend and to see the writing on the wall. But I think that, actually, I hope I'm kind of a mixture of both, because I want to be able to stick with the trend when the trend is obvious. I think the trend is obvious in terms of the dollar. I don't see a lot of reason technically or fundamentally for that matter, to believe the dollar will turn, but I want to keep my eyes and ears open to signs of a change. I think that we should try to incorporate a little bit of both. I would hope that I'm a little bit more of the former, because especially in the foreign exchange market, and it's different in stocks, especially in the foreign exchange market, these trends develop for such large, dominant, unbelievably long-lasting trends and fundamental reasons. Foreign exchange trends don't change every day. Stock market, it's a little bit different. And I think the foreign exchange market, it's best suited for someone that is comfortable sticking with the trend and is not going to be tempted to try to pick tops or bottoms. If you want to try to pick tops or bottoms, I think the stock market is a lot better way to go, because stocks have much shorter trends. A long-lasting trend in the stock market is something like Apple Computer or Google. Over the past, arguably the past couple of years, the trend has been to the upside. But then again, the trend was the upside despite the fact that Apple stock came down a lot in 2008 when the stock market crashed. And the stock market really, it has these short bursts. And if we try to pick tops or bottoms, I think it's much better suited, that the stock market much better suits us. Foreign exchange, May 2010 was on a daily chart, the high of this trend. But if we go back to a monthly chart, my monthly charts go back to 1988. From the highs of 1989, we had a long-term trend to the downside in 1995. That's a 6-year trend. Now, 95, we corrected all the way back up to 2000. That's a 5-year trend. From the top of 2000 until today, on the monthly chart, we basically have a long-term trend to the downside. That's another 10 years to the downside. Now, within that, I'm really smoothing over a lot of data. Of course, within those trends, we did have major corrections. I mean, after all, from the top of 2000 to the bottom of 2005, we then saw a correction from 2005 up to 06. From 06, we saw a big move down to 08. Even though, I should say that, yes, these longer-term trends are dissected by smaller-term moves, but those small-term moves still last 2 to 3 years. I think it's very rare that you'll find stock trends that develop a trend for that amount of time. Look at Ford stock, hit that very, very big low of near $1 a share, rallied back up to 14, but now it's sort of consolidating. It's not, and that is only after a 2-year correction. Foreign exchange, I think, is much longer lasting. How much time every day do we have to commit to trading? This is very, very important. All too often, I will read emails from traders that will say, I don't have a lot of time to trade every day. I have a full-time job, I have other commitments. Therefore, I want to be a scalper, because scalping and day trading, it means I'm going to get into the trade for a few minutes of the day, make 10, 15 pips. Maybe I'll sit in the trade for like an hour, make 30 pips, and then get out, go back to my normal life, and that's great. I think the opposite logic should be applied. In my experience in day trading the foreign exchange market, and it's very, very tough, and day trading stock market, which is also very, very tough. I think day trading, scalping, the shortest term trading is the most difficult. Longer term trading, a lot easier. A few different reasons. Better risk-reward ratios, we have more time to get in and out of the trades, etc. But the short-term day trades, yesterday I was hosting a little bit of a trading class, and we're looking for a day trade. And I started the class, I think, like 8 o'clock in the morning. And I did not find the entry until 10:30 in the morning, 10:30 a.m. Now, I didn't want to get in yesterday at 8:30 because we had news in the U.S., and, I really don't like to get in a trade just before a big piece of news. And then we had pending home sales, At 10 a.m., we had the Reuters numbers at 9:45. So all these pieces of news came in, and that sort of, threw me off a little bit. But I didn't get into the trade until 8, 10, 10:30, and I was looking at the charts since 8 o'clock. So it took me 2 hours to find a trade, and then once I got in that trade, it took me another couple hours to wiggle out of the trade. Point being, that took up a good 4 or 5 hours of my life watching one trade, waiting to get in, waiting for that signal, waiting to get out. Someone with a limited amount of time on our hands, if we have full-time jobs, that's not possible. If we have full-time jobs, if we do not have a lot of time to commit to trading, and if we're new to trading, even if we're not new to trading, but I think if you just want to look for a little bit of a more consistent, easier way to go, look to longer-term trades. Now, I think when we say longer-term trades, a lot of people get turned off. Said, no, I don't want an investment. I don't want to just buy the euro and hold it for 2 years. And, I don't mean necessarily very ultra-term, long-term trading. I'm talking about something a little bit in the middle, where we would use daily charts. Let me give you a great example. Great example is the Aussie dollar. Take a look at this chart. We know we draw our uptrending support lines from the significant lows. So we take the low December 1st. This is a daily chart Aussie dollar. December 1st, 2010. Then we take the next significant low, which was January 31st of this year. And that using those two lows, we can draw our uptrending support level. We drew it a little bit differently. That's okay, because we would have adjusted these lines. Or we could have adjusted the lines to incorporate the most recent significant lows. Either way, we would have been right in doing so. Well, the next signal to get in is the next time the Aussie dollar pulls back as close as possible to our uptrending support level. The last time this happened, and let me move back my line to originally how I had it, because I think that line, that serves a little bit better purpose. Either way, you cut it. The Aussie dollar gave us a great entry. Now, the moment that we really had the confirmation that this line is strong, we drew the second low on January 31st, and then the next signal after that was February 15th. The next signal after that was February 22nd. So we have about a week's difference. And if I wanted to buy the Aussie dollar now, I think it's very, very clear we'd wait for a pullback somewhere near the parity, 1.0000. But I don't see anything wrong at all in waiting for these daily chart signals. We do not have to wait months and months for this to occur. In fact, we're looking at signals that are only spread out about a week apart. Now, the beauty is you get involved in this trade, you place a protective stop at a level that logically you don't think the market's going to go to. Here's a red line. That's where, figuratively, I would place a stop. So I didn't measure exactly. Limit orders, well, we can place our limit orders a little bit below resistance. Let me change my limit order to green. We can set ourselves, I'm going to go long as close as possible supports. I'm going to take profits as close as possible resistance. I'm going to place my stops a little bit below support. And by the way, Reserve Bank of Australia had an interest rate decision today. They kept rates unchanged at 4.75%. There's a nice little carry trade involved in the Aussie dollar currency pair. Almost zero rates in the U.S., 4.75 in Australia, not too bad. So a lot of fundamental reasons why I think the Aussie could continue higher. I don't know if they're going to raise rates tomorrow. I don't think so. But I think over the long term, this continues to trend higher. This is a much more relaxed type of trading, because what we can do is if we did not get in, we could even place a limit order, say, I'm going to get in the Aussie dollar. Well, support's at 1.0000 at the parity. I don't know if we're going to get all the way down there, so let me add a few pips to that, 1.0030. And place our protected stops at 99.70. So we're risking 60 pips. But if we're able to get in near parity, we're at 101.80 right now. Risking 60 pips, we would have made 120 to 180 pips. That's a 3-to-1 risk-reward ratio. We're doing the right thing by trading in the same direction as the long-term trend, and we don't have to watch this trade every moment of the day. We could very, very easily send up an alert so that if and when the Aussie dollar comes down to the parity level or 1.0050, we'll get a cell phone or email alert telling us, hey, the market's down here. I'll turn on my trading station. I'll buy a little Aussie dollar, place a stop, and then I can leave it. If we want to day trade, it seriously requires a lot of time. And it's not a fun way to go. Now, day trading does have its benefits. After all, we are able to take a small amount of capital, use it, get in a trade, make money, and get out of the trade, and then use that same amount of capital for something else. I mean, there is opportunity cost. That if we have a limited amount of capital, that if we tie it up in the Aussie dollar, that means we can't take any of the trades. That is the main argument for day trading proponents within the stock markets. I tell you, it allows us to come in with a $5,000, and that $5,000 professional day traders will use leverage and get much more buying power, and then we can use that very big piece of money to get in a trade, make 10 cents, and get out of the trade, and then use that same piece of money for something else. Well, foreign exchange, we already have very high leverage. The trends are a lot more longer lasting, so it really behooves us to hold on to the trade. So I think that the foreign exchange market, honestly, I think it's not, a day trader is better suited in stocks. I think that if you want to trade the foreign exchange market, longer term trends are to our advantage. Another reason why stock traders day trade so much is because, it had become so popular, is because the stock market closes every day at 4 o'clock. And it's very risky if you buy a stock, a very large position, to hold it at 4 o'clock, hoping that news does not come out or the market does not gap open one way or the other by 9:30 in the morning the next morning in New York, when the New York Stock Exchange opens. Foreign exchange, it's a seamless market. There are no real closes and opens. And even over the weekend, the only time the market's not open, from Friday evening to Sunday evening, there's very seldomly do we ever see gaps. Question is, how long would you say the carry trade could work? The carry trade, it's a great question. The carry trade is the comparison of higher interest rates versus lower interest rates in any currency pair. Now, we look at the euro and the pound, there's not a big difference in interest rates, 1% versus 0.5%. In Australia, we have 4.75%, and in the U.S., we have that 0 to 0.25%. So the logic dictates that if I have a piece of money that I want to put into a savings account, would I put it in Australia and make 4.75%, or would I put it in the U.S. savings account and make almost no interest rate? Logic dictates that capital will always, barring other circumstances, capital will always move into those currencies with higher interest rates, barring news and unforeseen events, that sort of thing. I cannot foresee a day that, to answer your question, I cannot foresee a day that the U.S. will have higher interest rates than Australia for a few different reasons. The U.S., despite everything that has happened, still remains to be, at least considered by the market, to be one of the most stable economies out there. Not that the Australian economy is not stable, but on a relative basis, the U.S. is a little bit more stable than Australia, as Australia is considered to be more stable than Brazil, and Brazil is probably more stable than Mexico, etc. Maybe I'm mixing them up. The foreign exchange market will allocate capital, and this is all of us unknowingly making these decisions, will allocate capital, more capital to those currencies that in those economies that appear to be more stable. Because of that, just the same way that if we want to buy state bonds, for example. Well, we have in the U.S., we have a lot of states that are in trouble right now. We have the more stable states, I would say, think of something like, I don't know, Massachusetts and New Hampshire, maybe somewhere in the Midwest. Then we have, on the other side of this, of the equation, you have the states that are really in a lot of trouble and a lot of debt right now. It's in the news, the protests, I think, where is that? Minnesota? Michigan. Not Michigan, Minnesota. Then we have states with huge budget deficits like New Jersey, Illinois, California. They say California, the economy in California is about the same level as it is in Greece. And that's not good. If I have to make a decision what kind of bond I'm going to buy, well, California and Illinois and New Jersey have a much bigger budget deficit. They're going to pay me a higher yield because they know I'm taking additional amount of risk. by buying California bonds as opposed to Massachusetts. Well, Massachusetts isn't even a good example because they have a very big budget deficit as well. Point being, the foreign exchange market is going to pay you a higher interest rate for those currencies that you take a little bit more risk. Australia, relatively speaking, is a little bit more risky than the U.S. Therefore, it pays a little bit of a higher interest rate. And as the worldwide economy improves and the Federal Reserve one day raises rates, that will ultimately benefit Australia because Australia is an export-driven economy. And they do benefit when other economies can purchase those commodities, gold, silver, copper, platinum, palladium, etc. So as a result, I think that as the U.S. Federal Reserve starts to raise rates, the Reserve Bank of Australia will also continue to raise rates. This carry trade is perpetual, to answer your question. Go back to a monthly chart, and this immediate trend began September of 2008. That was a low. Before that, we hit the low of March of 2000. We always had higher rates. As far as I know, we always had higher rates in Australia versus the U.S. However, to really fully answer your question the right way, I don't know necessarily that you're always going to see the market move how we would expect it to move. Meaning, from the year 2000 to present day, the Aussie dollar's moved up. Well, it makes sense. The Aussie's higher interest rates than the dollar. Now, I'm guessing that Australia still had higher rates in the dollar, in the late 90s. But what changed right around the late 90s, year 2000? My theory is we went from a budget surplus to a budget deficit in the U.S. And as that occurred, what happened was that the dollar really started to weaken. And that forced the Aussie dollar currency pair up. Really, I expect this carry trade to last a very, very long time. I expect the Aussie dollar trend over the long term to last a very, very long time until, and if you're looking for that fundamental factor that'll change everything, excuse me, I would look for the U.S. government to do something about the deficit, to actually figure out a way to start working off the deficit. The balance of budgets, about $14 trillion deficits, and we have to start find a way to work off. It doesn't mean we have to pay off the whole thing, but we have to start moving in the right direction. I think when that happens, then I think you'll see a tremendous rally in the dollar. And I think right now the dollar is ignoring all of that. One of the big reasons is the deficit. Question is, would it be okay to trade the index ETFs like the S&P 500 rather than individual stocks? Absolutely. No, of course. I mean, there's benefits and drawbacks to either one. I mean, the benefit with trading individual stocks is you have the potential to have those really, really big moves. Now, you trade stocks, you also take that individual stock risk. You trade the S&P 500 or an ETF, exchange traded funds. So you just want to trade the Dow Jones Industrial Average or the S&P 500. You're taking market risk. Stock market, if you trade a stock, you're taking market risk and stock risk. So, yeah, and I think there's less of a chance of gaps. However, you still do have the risk of gaps in any market. Now, getting back to our topic of the day, because I don't want to get too far off track. I do have some really, really important points. I am using MT4 platform, by the way. I have some free downloads all over the internet. Really, really great charts. How active a role do we want to play in our trading? And this goes right into the type of strategy. If we want to play a little bit of a more active role, a less active role, if you want to play a little bit of a less active role, a passive role in the market, say, I'm going to buy when I should buy, I'm going to sell when I'm going to sell, but I don't want to get my fingers too much involved in the individual trades because I have this suspicion that the more buttons I press, the more money I'm going to lose. That has been my position for many, many years. I truly believe the more times I press buttons, the worse my odds are at actually making money. Usually our first intuitions are the best. Maybe we should pursue a little bit of a longer-term strategy. if the longer-term strategy proves to make money, now I don't want to completely swear off of day trading altogether in a foreign exchange market because there are benefits to that as well. But with any trader, what I would suggest, start with a moderate long-term strategy, like the Aussie dollar strategy that we talked about today. Draw uptrending support lines. We're trading in the same direction as the trend. We're going to try to go long near support. If you want to incorporate an indicator, something like the Bollinger Bands, where you buy near the lower band, take profits in the center or at the upper band. Always the trend is your friend. A very simple strategy. It's not going to require us to press too many buttons. It's not going to require us to watch trades all day and all night, but rather just to get in at the best price. I like to think of it a little bit more of an investment. Sorry, I wanted to cough off the microphone. Now, if this proves lucrative, and if we can over time prove to ourselves, hey, we've made money over and over again, we could then go to a 4-hour chart from a daily chart and look for a little bit more frequent, high-frequency trading situations. And if we, month after month, that our trading accounts are consistently growing, doesn't mean you have to make trade money in every trade. But over time, if you continue to make money, move to a short-term time frame and try that out as well. But I truly believe the correct path of any trader is to start with the long-term time frame, try to make money on a long-term basis. If you can do so, then we can narrow our focus to a short-term strategy. If you have a Macintosh, by the way, and I do, there are a couple different ways to do so. I don't want to take up everyone's too much time. But you can either use a virtual Windows, or you can actually just partition your hard drive and install Windows on your Macintosh. So you can have Windows and Macintosh running separately. That is my solution. I run MT4 and Macintosh on Mac computers all the time. Works fine for me and pretty much seamless. I'll tell you what, I'm on it right now. So I haven't really seen any complications. That's if you partition a hard drive. At any rate, I want to get out of my area of expertise, and computer tech is not my area of expertise. Now, one of the revelations that I personally found, I turned the charts off because I want to show you something else, that I found most helpful, is that from a very, very early time, I was always much more attracted to technical analysis. It made more sense to me. This chart makes sense to me. I don't know exactly why, and I could be wrong in my theory why the Aussie seems to be going up against the dollar. I think it's a budget deficit in the U.S. I think obviously there's a carry trade involved. Gold prices near all-time highs certainly benefit the Aussie, and gold tends to go up as a hedge towards a falling dollar. I could be wrong. Technical analysis always makes a lot of sense to me. I always gravitate towards technical analysis. But I knew, trading the foreign exchange market, I cannot ignore fundamental analysis. So I decided, let me try to understand fundamental analysis in a way that I can understand it, from a technical analyst point of view. So this is what I did. And I have another strength. I don't have a lot of strengths, but this is one of them. I happen to really like using Microsoft Excel. Well, what I did is, on January 3rd, the beginning of this year, I love creating little Excel projects. And I really encourage you to do so as well. I think for traders, if you want to do research, Excel is the best tool that we could use. Well, I wrote down on the top of this Excel sheet the 8 different currencies that we follow. And every single day, and I probably talked about this in the past, but I really love this idea. Every day, January 3rd, there was some news that came out in the Eurozone. I don't remember what the news was, but it was better than expectations, and it showed a general improvement in the economy. So I gave it a score of +1. Well, the same day, January 3rd, some news came out, some Swiss news came out, and it was below expectations, and it showed a general decline in the Swiss economy. So I gave it a score of -1. In the U.S., we had a little bit, the news, 2 pieces of news that were good, 1 piece of news was bad, so I gave it a score of 0.5. But generally speaking, if the news is good and it beats expectations and it shows the economy is improving, I give a score of 1. If it shows a decline and misses expectations, -1. If there's no news, I give it a 0. I then add up all these 1s and 0s and kind of keep track. And this is the result. This Excel sheet shows us the 8 different currency pairs, just color code key at the bottom, and shows us since the beginning of January up until today, excluding the Bank of Canada news because I didn't have a chance because we've been on this webinar. But just until before this webinar started, I've been keeping track of all this news. And the light blue line, the euro, we definitely see has been the recipient of some really, really good news. Much more good news than bad news. The white line, the US dollar, that has also been the recipient of very good news. Now, though it's a little bit deceiving why the white line, the US dollar, is the strongest currency. It's not. It's just because we get a lot more frequent news in the U.S., probably because of U.S.-based economic calendars. So there's a lot more news in the U.S., so disregard the white line. Other than the white line, we know that the euro has been the recipient of the most amount of positive news, followed by the green line, that's the Canadian dollar. Now, on the other side of the spectrum, we have the blue line, that's the Aussie dollar, the Australian dollar, and I am not taking into consideration any earthquakes or floods or anything else that has occurred in Australia and New Zealand over the past couple of months. 2 earthquakes and 1 flood from where that counts. This is just economic data. Now, put the two together, the technical analyst in me now understands, yeah, the news is a lot better in the Eurozone, so the anticipation is the Eurozone is probably going to raise rates sooner than Australia. Therefore, I would want to buy the Euro-Aussie currency pair. Excuse me. Now, same old true with the CAD against the Aussie. We have the Aussie CAD. Now, I haven't looked at a chart in a while. In fact, let me see if I can find the Aussie CAD currency pair. Let me see here. Aussie CAD. There we go. And I'll show everybody the pair. And surprisingly, it makes a lot of sense. Here's the Aussie CAD. Now, remember, I started this experiment January 3rd. January 3rd is right here. I drew a line. We hit a high on January 3rd of 101.57, a low of 1.0076, or 98.92. There has been a serious move to the downside in the Aussie CAD. I happen to believe, at least to a small extent, that the market is paying attention to the news. That since the beginning of the year, the news has been significantly better in the CAD in Canada than it has been in Australia. As a technical analyst, I understand this approach. Let me show you some other things I've been working on. This one, I happen to be very, very proud of, is as follows. This took a long time to do so. Okay, so we take a look at the following charts. And what I've done, I don't know if you can see the tabs on this Excel sheet at the bottom, but I've taken every single currency, whether it's the dollar, or the yen, or the Aussie, or the Kiwi, and you can see scrolling forward, there's a lot of numbers here. And each currency, I try to analyze the biggest numbers. Now, I'm not perfect. I've been tracking a lot more numbers in the U.S. than I have in other markets. Let me expand this a little bit so everybody could see. So I don't cover so many numbers in Japan, but I do cover the big one, the Tenkan number. Let me see if I want to show everybody. Here's a list. I've created a list of all the different numbers. There we go. You can see that list now. In the U.S., it includes CPI, unemployment, the FOMC, the Dow Jones Industrial Average, dollar Swiss, the big markets. PPI, GDP, trade balance, new home sales, etc. New Zealand unemployment, CAD CPI, Aussie unemployment, etc. Now you go to any one of these charts, and I'm comparing, the equity markets along the same lines as, or alongside the respective economic numbers. So, for example, earlier today, what do we have in the Eurozone? We had some few Euro numbers, including unemployment, which actually fell. So now we can look at the Euro unemployment number. That's the blue line. Just today, Euro unemployment crossing the 9.9%. That's pretty important. because it's actually below our 12-month moving average. Now, I always use a 12-month moving average because it makes sense to me. Hey, there's 12 months in a year. Now, maybe that's not so important. But we take a look at the European unemployment figures. That's the green line. Compare them to the CAC, that's the equity market in France. That's the violet line. That's Euro unemployment. That's the green line. And the blue line is the DAX. That's the equity market in Germany. And generally speaking, we have a pretty positive, inverse or opposite correlation. Unemployment goes down, stock markets go up. Unemployment goes up, stock markets go down. Unemployment went down today. Not today, but it was reported today. As a result, I would logically expect to see stronger stock prices. Reserve Bank of Australia left rates unchanged today. But if I expect the Reserve Bank of Australia to raise rates, if I see, for example, here is the unemployment rate in Australia. Last figures I saw 5.0%. I might have missed the last month's numbers. But there's an inverse correlation. If I see unemployment really start to drop in Australia down below 5%, 4.5%, maybe below that, I'd give more credence to the idea that the Reserve Bank of Australia is going to raise rates. This, to me, as a technical analyst, makes sense. And getting back to the topic of the day, fundamental data, if I just read the article on Bloomberg.com, or if I listen to the news, especially on TV, it can be very, very deceiving. Watch this Friday's non-farm payroll number. And the unemployment rate obviously will also be released. I believe they're expected the unemployment rate to rise a little bit, 9.1%. It is amazing how many different interpretations of the news we can get from the same piece of news, depending on what media source we're listening to. And I don't want to, I'm not trying to make a statement as far as the political sides of a media station, but the fact of the matter is, you listen to one media station. I remember the last non-farm payroll number. Non-farm payrolls, I believe they came out a little bit worse than expected, but then, or maybe a little bit better than expected, and the unemployment rate dropped, and that was good. But then another analyst came out on TV, says, no, it's bad because there's less people in the workforce. So how do I know if it's good or bad? Here, by the way, is U.S. unemployment. This, to me, makes a lot of sense. You can't argue with this. Unemployment is dropping to the downside. Now, analysts will always say, yeah, unemployment's dropping because there's less people in the workforce, there's less people looking for work, therefore more people are actually out of work. Unemployment's a little bit of a tricky situation. But it's very, very easy for me as a technical analyst to look at the CPI, Consumer Price Index, the PPI, the Producer Price Index. I can look at the trade balance figures. I can take a look at this chart. New home sales versus the Dow Jones Industrial Average. Dow Jones Industrial Average goes up, 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 up. New home sales near the low. Wasn't it the housing market that got us into this recession in the first place? That tells me if the housing market starts to move to the upside, if I see new home sales breach this level, we've been trapped under 330,000 new homes every month. If I see new home sales above the 446,000 level, May of 2010, I know that the weakest segment of the economy is really starting to fire on all cylinders. But right now, as long as new home sales stay near the lows, not a lot of reason for the Dow Jones Industrial Average to go up. That makes me more bearish than the Dow Jones Industrial Average. I know I'm out of time, but with Excel, what I can also do is evaluate my strategy. I can plug into an Excel chart my different strategies, like my RSI reversals, and let's just make up some numbers. Let's say I made $45 on that, and I can open up a demo account for every single different strategy and trade them separately. Let's say I lost $76 on that trading account in the Aussie dollar. I made a lot of money. I made $100. In the dollar CAD, I lost a lot. I lost $200. We can start to see at the bottom of this chart, little lines will start to emerge. And this very, very simply tells us, okay, I should be trading certain accounts and I should not be trading other accounts. I should be trading certain strategies and not trading certain strategies. Now, I'm just making up these numbers, obviously. The point being is that Microsoft Excel, which I feel is one of my strong points, much more so than other areas, allows me, as a technical analyst at heart, to very logically quantify what type of trader am I, where should I be placing my trading capital. Because after all all of us that are traders, we're all small business owners. Our small business is our trading career. If we owned a small business like a grocery store and we knew that we would sell a lot more cantaloupes than we would oranges, well, it makes sense to buy less oranges and buy more cantaloupes because that happens to sell. Well, in trading FX, if I know that, according to my little fictitious numbers over here, that my RSI breakout strategy on the dollar CAD makes a lot of money, but on the RSI reversal on the dollar CAD it loses a lot of money, wouldn't it make the most sense to place more capital in those strategies that make money and take away the money from those strategies that lose money? I may not be, the best trader under all circumstances, but I think that our strength lies as not computers, not automated trading strategies, but human beings, is that we can constantly self-evaluate our own progress and to say to ourselves, okay, I know I'm not going to be the jack of all trades, I'm not going to be an expert at everything, but I'm going to be smart enough to put money where the money has the best chance of growing and to take money away from from those areas where it has the least chance of growing, and to identify my own strengths and to identify the answer to our topic today. What kind of trader am I? I hope this has been helpful. If you have any questions, you can contact me directly, www.forexknowledge.com. Hope this has been helpful and given at least a little bit of an insight. Very special thanks to FX3. Please see their calendar because we'll be back on with much, much more. We thank you very much for joining us. We wish you a great day, all profitable trades, and we look forward to seeing you back soon.